Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from the Mortgage Mag on the 10th of July, expectation of November rate cuts prompts record short rate borrowing. Topic number two from Stuff on the 10th of July, housing changes will make it harder for disabled people to live, advocate says. Topic number three from interest.co.nz on the 9th of July. QV says house hunters are going into hibernation as values continue to fall. Topic number four from New Zealand Herald on the 8th of July. Lending limits, how they could affect bank mortgage books. Topic number five from One News on the 8th of July. Millions spent on Kāinga Ora developments now in limbo. So to start this week in review, we'll go with the topic number one from the Mortgage Mag on the 10th of July. Expectation of November rate cuts prompts record short rate borrowing. In May, the number of borrowers opting for 6-month mortgages reached a new peak, anticipating the upcoming interest rate cuts. Most banks now expect the Reserve Bank to begin reducing the OCR from November as the economy slows, unemployment rises, and inflation returns to the 1 to 3% range. Recent data from the Reserve Bank of New Zealand reveals that the proportion of 6-month fixed-term mortgages for owner-occupiers hit a historic high of 17.1%, meaning about 1 in 6 mortgages. This is a significant jump from last year's 3.4%, indicating borrowers' expectations of imminent interest rate reductions. Although the RBNZ forecasts a rate cut by mid-next year, financial markets have already priced in a November cut with a 50% chance of it happening in October. Investor borrowing for 6-month terms increased from 18.7% in April to 21.7% in May, representing about 1 in 5 mortgages. Despite these highs, the 1-year fixed term remains the most popular, accounting for 36.5% of new owner-occupier loans, down from 39.4% in April. For investors, 1-year terms made up 40.2% of new loans, down from 45% in April. Total mortgage lending rose to $7.1 billion, an 18.5% increase from April's $6 billion, and a 22.8% rise compared to the same month last year. Fixed rate terms comprised 82.3% of total new residential lending, up from 81.9% in April. Owner-occupied lending increased to $5.2 billion in May, and investor lending grew to $1.8 billion. For owner-occupiers, lending on terms longer than 18 months remained stable. The share of 2-year fixed mortgages edged up from 8.6% in April, and 3-year fixed terms rose to 3.1% from 2.8%. 4-year fixed terms remained at a historical low of 0.3%, and floating term loans for owner-occupiers decreased from 17.7% in April to 17.1% in May. For investors, the share of 18-month terms increased from 8.9% in April to 11.9% in May, while 2-year fixed terms fell from 7.8% to 5.9%. In commercial property lending, investment property dropped by $72 million, 13.2%, to $473 million. Commercial property development surged by $86 million, that's an increase of 97.7%, to $174 million, whereas residential property development declined by 2% from $98 million in April to $96 million in May. My advice for anyone who's got interest rates coming up for refixing: talk to your mortgage advisor, get some advice from them before you refix your interest rate, because it might be in your best interest to look at refinancing or restructuring your loans as well. Topic number two from Stuff on the 10th of July, housing changes will make it harder for disabled people to live, an advocate says. A new policy aimed at increasing housing supply might result in more homes that are inaccessible to disabled individuals. Last week, the government announced the removal of minimum floor area requirements for apartments, a move intended to lower costs and boost availability of affordable housing. However, this change could pose challenges for wheelchair users, who already face difficulties in finding suitable accommodations. Critics argue that the government's modifications to housing regulations will negatively affect disabled people, complicating their living situations. Housing Minister Chris Bishop revealed a series of changes to stimulate housing growth, including the elimination of minimum floor area stipulations for apartments. He explained that these requirements currently drive up costs and restrict the availability of cheaper apartments. Patricia Austin, a senior lecturer in architecture and planning at the University of Auckland, highlighted methods for manoeuvring, transferring and accommodating specialised equipment, which smaller apartments fail to provide. Narrow corridors and tight right-angle turns exacerbate the accessibility issues, making daily activities challenging for disabled individuals. Juliana Carvalho, a 42-year-old wheelchair user from Papamoa Beach in Tauranga, criticised the policy as regressive, predicting an increase in inaccessible homes. She shared her own struggles in finding suitable housing, recounting a period where she had to shower on her brother's porch due to a lack of accessible facilities. Carvalho emphasised the isolation that inaccessible housing can cause, noting that it can prevent hosting friends or family who use wheelchairs. Bishop acknowledged the concerns, stating that smaller apartments might not be suitable for disabled individuals or larger households. However, he argued that removing these restrictions would provide more housing options, especially for young singles or couples. He assured that the building code, which ensures rooms meet safety and usability standards, would still apply to all new apartments. Bishop stressed the importance of social housing meeting the needs of disabled people, urging social housing providers to consider these needs when constructing and retrofitting properties. My opinion on this is not every property is suitable for every individual in New Zealand, but increasing the supply of housing is certainly going to help make housing more affordable and increase the number of properties that are available for rent or purchase, which across the board will be good in my opinion. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and these events are available live either online or in person at our office in Ellerslie, Auckland. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website propertyapprentice.co.nz. Topic number 3 from interest.co.nz on the 9th of July. QV says house hunters are going into hibernation as values continue to fall. Housing values in New Zealand declined for the second consecutive month in June, according to the latest data from QV, Quotable Value. The QV House Price Index, HPI, shows the average dwelling value at the end of June was $916,285, which is a decrease of $10,487 since April. The most significant declines occurred in the Auckland region. The pace of decline is also accelerating. QV's HPI indicates the average New Zealand dwelling value fell by a negative 0.2% in the 3 months to May, which increased to negative 0.9% in the 3 months to June. In Auckland, values dropped from negative 1.4% to negative 2.8% over the same period. Other regions experiencing declines greater than 1% in the 3 months to June include Tauranga and Palmerston North, and the Wellington region at negative 1.2%. The QV HPI report attributed the declines to frosty economic conditions affecting most main centres. James Wilson, QV Operations Manager, noted that some areas, mainly in the South Island, still show modest growth, though even these are diminishing. According to Wilson, even Christchurch and Queenstown, previously strong markets, are now seeing little or no growth. Wilson highlighted that challenging economic conditions are making it hard for potential buyers to save deposits, secure bank financing, and manage mortgages with interest rates around 7% and ongoing inflation. Wilson pointed out that many buyers are delaying purchases until conditions improve, potentially after winter. He added that downward price pressure is now evident across all market segments, with investors, owner-occupiers and first-home buyers, who remain the most active group, all stepping back significantly as the year progresses. My advice is, if you're in a position to get lending, then what is stopping you from entering into the property market? This is a buyer's market when there's clearly less buyers in the market. You've got the ability to negotiate really good discounts off some properties and secure a particularly good deal. And then when interest rates come down and the property market starts to recover, you will reap the rewards of that. Just make sure that you're buying the right sort of property for your individual financial position. Topic number 4 from the New Zealand Herald on the 8th of July, lending limits, how they could affect bank mortgage books. Banks are observing the potential impact of new lending restrictions on their mortgage portfolios if interest rates drop, although they anticipate the effect will be limited due to current high interest rates already serving as an affordability measure. James Layden, Bank of New Zealand's General Manager of Home Lending, stated in an interview with Markets with Madison that there are possible interest rate changes and new regulations, making it an interesting time to see the outcomes. Banks have spent the last year preparing for the Reserve Bank of New Zealand's new restrictions aimed at safeguarding the financial system from risky lending as interest rates fall. The new debt-to-income, or DTI limits, stipulate that only 20% of a bank's mortgage portfolio can consist of loans exceeding 6 times an owner-occupier's annual pre-tax household income and 7 times for property investors. Concurrently, the easing of loan-to-value, or LVR restrictions, allows banks to lend more to borrowers with smaller deposits. Layden noted that while the relaxed LVR restrictions could benefit property investors, the new DTI limits might have the opposite effect, particularly if interest rates decrease. However, he downplayed this concern in the current high-interest environment. High interest rates have already constrained borrowing capacity by affecting loan serviceability, acting as a natural limit on borrowing amounts. This has led to a reduction in maximum borrowing capacity for customers. Continuous monitoring of the mortgage portfolio will be essential to understand the ongoing impact. The new restrictions may lead to smaller mortgage sizes, reducing banks' interest earnings. Nevertheless, Layden expressed support for the changes, acknowledging the regulated nature of the industry. Banks capitalised on the previous low interest rate environment with many new loans exceeding 6 times the borrower's income, particularly in 2021, as noted in the Reserve Bank's recent financial stability report. So my thoughts on this are, it's not until interest rates come down that we're going to actually see what the impact of DTI restrictions will have on lending, because at the moment, by far and away, the majority of restrictions on lending is due to the debt servicing, so loan serviceability testing at 9% interest rates across the board. That's far more restrictive. And also with the banks being allowed to lend 20% of all of their lending each month to people above the DTI restrictions. At the moment, with those percentages being well below 10%, the impact is going to be very minimal until interest rates come down significantly. Topic number 5 from One News on the 8th of July, millions spent on Kāinga Ora developments now in limbo. Kāinga Ora has spent nearly $5 million on 2 state housing projects that have been scrapped for being financially unviable. Documents obtained by One News through the Official Information Act show the taxpayer costs linked to 2 abandoned developments in Auckland. The Ngā Kāinga Anamata Homes of the Future project in Glendowie, Auckland, was internationally praised and intended to highlight Kāinga Ora's climate-conscious initiatives. It aimed to tackle energy hardship, poor building conditions and climate change. The plan included replacing 8 state homes on Crossfield Road with 30 sustainable homes, a 3-storey apartment and 2 townhouses. However, 2.5 years later, no construction has occurred. Kāinga Ora retracted consent due to COVID-related delays, escalating costs. Over half of the $3.5 million spent on the site went to consultants, contractors, and low-carbon design research, which Kāinga Ora plans to use in future projects. Senior architecture lecturer Bill Mackay praised the concept, but questioned its timing given inflation and other pressures. He deemed it overly ambitious under current conditions. At a second site in Onehunga, Auckland, more than $1 million was spent demolishing 62 state homes for planned apartment-style public housing. An additional $350,000 went to consultant, consents, and site work before Kāinga Ora deemed the project not cost-effective and cancelled it. Action Station campaigner Vanessa Cole criticised the situation as a deep injustice to families displaced from their state homes who expected an increase in public housing. With nearly 500 households on the Mangakaiki Tamaki local board area waiting for public housing, Cole emphasised the unfairness of halting the developments. The Onehunga site will eventually be sold for public and private development. Kāinga Ora declined to comment on the cancelled projects, as will I. Continuous learning helps you to stay updated on new investment strategies and regulatory changes, helping you become more confident and resilient in your investment approach. If you want to learn more about investing in property, join our How to Succeed with Property Investing event. During these 2-hour workshops, we cover off recent property market data, and as an experienced property investor and financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our events. Alternatively, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website, propertyapprentice.co.nz. Thanks for listening.